Hello, and a very warm welcome to all of you. I'm Diksha, and I'm associated with AD Naik Group, wherein we have helped 4,500 families across 17 countries to achieve their wealth creation goals through us, and we have done that consistently over the last 33 years now. Before we start the session, I would like to introduce you to one of our investors, Mr. Suraj Dodeja, who wants to share his experience with our organization. May I request my colleague Esteban to play the video?
Hi everyone. Naik Wealth and our family has been associated for nearly 4 years now. In terms of wealth management, we did not have a professional consultant before this and we felt it was not required. But over the past 4 years, we realized the amount of impact that an organization like Naik Wealth and more importantly, the people behind it. I think they have some of the best experts in the industry and they always keep their clients first while giving the advice. And today it's reached a point where we do not even need to discuss, and based on whatever suggestions that the team comes up with, we are happy to go with. Initially, we always wanted Nikhil to be a part of the meeting. We did not want to sit in a single meeting when he was not there. There have been times when I told the team that, let's cancel the meeting and come back some other day because Nikhil was not in the meeting. It's over a period of time that our trust built on the financial experts that are a part of Naik Wealth. And today we do not even remember Nikhil when we have meetings with the team. That's how good the team is. And we are very proud of ability that this team brings to the table. And we look forward to decades of relationship with Naik Wealth.
Thank you, Esteban. May I request Mr. Nikhil Naik, the Chief Growth Officer of AD Naik Group, to share with our investors a few tips to use their money in a smarter way.
Nikhil sir, just a moment. I think we cannot hear you. Your audio.
Yeah. Am I audible now?
Yes, sir.
Yes, sir. Yeah. Oh, okay. Yeah. Sorry. Thank you. So, thank you, Diksha. It's been absolute pleasure meeting all of you again, all the investors again. And I remember the times when we used to do these events during COVID times when everybody was at home and the life has gone back to physical world again, but it's still heartening to see the amount of response that we've got for today's webinar. I think one of the things that while working with so many wealthy families, one of the things that I have really realized, Diksha, is they work very hard. All the rich families, and I'm privileged to work with some of the very, very wealthy families and wealthy business owners. One of the things that I realized that they work very, very, very hard for their money, but they also ensure that the money keeps working very hard for them. And I think that is one single most thing that I thought has separated some of the successful investors. And one of the ways that we all can do, and since you all have invested time with us, one of the things that you all can actually do, or we as investors do, is just ensure that we do not have any money which is idle in our in our bank account. Every time you see money being idle in bank account, either move it to a sweep and fixed deposit account or actually move it to a liquid fund. And we've seen that if you're a salaried person, if you are a homemaker, you can still actually recover one house help's salary by actively managing money or not keeping money idle in your bank account. And if you're a business owner, we've seen that let's say you have money in your account and you have to pay your vendor after 10 days, 15 days. Every time you see money being sitting idle in your current account for more than 7 days, simply move it to a liquid fund or a sweep in fixed deposit, and that single thing can actually ensure one person's annual salary over a period of time. I think that letting your money sit idle, ensuring that the money works very, very, very hard for you, is something that we can actually all practice.
All right, sir. And I would also like to ask you about a broad perspective of the market right now.
Yeah, so the other day on a TV channel, I was asked that why did markets go down? And I said that the markets went down because markets had gone up. And we are here to listen from Nilesh Bhai also today, that how markets are going to pan out in coming times. But I think markets always work like pendulum. And I remember March 2020, when the markets went way below what everybody thought, fell by about 30% in 17 days. So markets tend to overreact to situations in good times or in bad times. And so, and I think we have Nilesh Bhai. Nilesh Bhai, good
Hi,
evening
Nikhil.
to you,
How
sir.
are you?
I am fine. Good evening to you, sir.
Good evening.
Yeah.
So,
So, Disha, we can just introduce Nilesh Bhai. And
yes, sure, sir.
yeah, I was just sharing, Nilesh Bhai, one of the qualities of rich people that I have worked with is they ensure that the money never sits idle for them.
Yes.
And the money, they work hard for money, but they ensure that the money also works very hard for them.
Them.
And yeah, Disha, and you could
Okay, sir.
introduce
Thank you,
Nilesh
Nick.
Bhai. We can just start
Yes,
off. Yeah.
yes, sir. Thank you, Nikhil, sir, for sharing those handful tips. In such a volatile market, we need to understand the mistakes we are making and take corrective actions as soon as possible. And to help us understand the 5 horrible mistakes the super wealthy are making and the 3 simple tweaks to fix it, we have with us Mr. Nilesh Shah. Mr. Nilesh Shah is the Group President and MD of Kotak Mahindra Asset Management Company. He was part of the team that received the Best Fund House of the Year award for all the mutual funds he has worked with. He is also a part-time member of the Economic Advisory Council to the Prime Minister. Ladies and gentlemen, let's welcome Mr. Nilesh Shah.
Thank you, Diksha. Very good evening to all of you. If I look at investors, whether they are rich or poor, there are certain mistakes which everyone makes. Now, the first mistake which an investor makes is related to what I will call control. If we read Mahabharata, just before the beginning of the war, Krishna Bhagwan walks to Duryodhan's camp and requests him to give 5 villages to Pandav and avoid this massacre. Duryodhan refuses. Bhagwan Krishna tries to explain to Duryodhan what is right, what is dharma, why he should share his wealth with Pandavas. And finally, Duryodhan replies, Janami dharmam, nachme pravrutti, janami adharmam, nachme nivrutti. Oh, great Krishna, please don't tell me what is right. I know what is right, what is dharma, but I can't follow it. And also don't tell me what is wrong, what is adharma. I know exactly what is adharma, but I can't stay away from it. In every investor, rich or poor, they have a Duryodhan. They are unable to follow what is right and they are unable to stay away from what is wrong. So my first recommendation will be, please recognize your Duryodhan. You need to control your Duryodhan. Do what is right. Stay away from what is not so good or not so right. The second thing which comes especially with the rich investors is complacency. Nikhil Bhai very correctly mentioned that rich people work hard for money and then ensure that money works hard for them. But there are many rich people who forget this. They become complacent and in the end up losing wealth. The best example which I have remembered forever is Bhagwan Dada, the famous actor from Albela. In his heydays, he was very rich, owning number of cars and bungalows. But he didn't take care of his money, his wealth. And eventually when he died, he was in not such a good condition. What happened with Bhagwan Dada happened with many business families, many rich people. They became complacent with their wealth. They stopped caring about their money. They didn't put their money to hard work and resulted into portfolio losses, resulted into losses. The third thing which most investors kind of miss is staying within the comfort zone. In March 20, I got a call from my colleague that Nilesh, I am with a family doctor and I want you to talk to him. The family doctor asked me that, look, I'm a medical professional, I earn enough, and whatever I have saved, based on your colleague's advice, I have invested in stocks, mutual funds. Now they are all down 30–40%. I am unable to sleep peacefully. I didn't want my money to compound at a high rate. But when money is down by 30–40%, I am unable to sleep. Now I'm telling your friend that sell everything, put it into bank FD. I know my money will continue to grow. I'll be comfortable with that. Now, this was during March 20 when markets had corrected. I had no idea where the bottom of the market was. I just requested that gentleman that let's talk after 3 months. What has happened has happened. As of today, there are lots of bad news, but please avoid taking any decision for next 3 months, and thereafter we will talk, we'll figure out what to do. Unfortunately for him, he still insisted on liquidating his portfolio and moving into bank fixed deposit. After 3–4 months, he called saying that what FDs is going to give return over next 3 years, the market has delivered in 3 months. Now, what should I do? Now, why will a person end up taking such a call? Because he wanted to operate within his comfort zone. His comfort zone was steadily growing money, no volatility, no downside. He was not willing to step out of his comfort zone. But all of you know that it's very, very difficult to predict market. The only thing certain about market is its uncertainty. If you enter into boxing match, mentally you have to be prepared for taking the punches. If you enter into market, mentally you have to be prepared to take the volatility. Now, if you stay within your comfort zone, expecting gradual return, no volatility, no downside, it's bound to disappoint you. You have to step out of that comfort zone where there will be volatility, there will be downside, there will be correction, there will be crashes, there will be losses. Only if you step out of that comfort zone into that battlefield, then only you can generate return. So clearly, as an investor, you have to recognize your Duryodhan, balance your greed and fear. You have to ensure that without complacency, your money works hard for you. You have to step out of your comfort zone to face volatility, losses, correction, because there's no free lunch. The other thing where I have seen many rich investors losing money is where they try to copy their friend, relative, or neighbor's investment style. There are many people who went into crypto not because they like crypto, but because their friend, their neighbor, their relative was making money in crypto. There are many people who have gone and bought into arts, not because they understand art, but because their friend, relative, or neighbor has gone and invested into art. Many people have gone to invest into private equity, venture capital funded unlisted companies, not because they understand what unlisted companies were doing, but they heard people were making a lot of money investing in unlisted company. Whenever you try to copy someone else's performance, whenever you try to copy someone else, it's bound to create disappointment. It's bound to create uncertainty for you. My recommendation to every investor, do what you are comfortable with, what you understand. No point in copying someone else because his risk profile, his investment objective could be completely different. And please remember that people always talk about their success. Very few guys talk about their failure. If you only hear about success, you may believe that this person is extremely lucky. But please remember that he or she have not shared their failure. Effectively, as an investor, you have to do what you are comfortable with rather than trying to do what someone else is comfortable with. As an investor, I have to manage my greed and fear. I have to create an equilibrium between greed and fear. As an investor, I have to make my money work harder for me. As an investor, I should do what I am comfortable with, what I can understand and appreciate. As an investor, I have to ensure that I'm willing to step out of my comfort zone to take risk, to manage risk. These are some of the common mistakes which people make and pay a price, easily avoidable, and that helps in truly creating financial independence. Now, as an investor, what should one do? I'll share some of the example which shows that investment is all about common sense. One of the person whom I knew, they were both husband and wife. They used to stay in Mumbai suburb of Khar. Husband's job was in Shivsagar estate, Worli. Wife's business was in Flora Fountain. Every day, husband and wife will travel together. Wife will drop husband in Shivsagar estate, Worli, and move forward to Flora Fountain. In the evening, she'll pick up the husband from Shivsagar estate and proceed towards Khar. While they were following this routine, the wife discovered that in Sendo's house, ground floor, a new bank had opened called HDFC Bank. In those days, banking hours used to be 11 to 3:30. But whenever she will go to drop her husband, 9 o'clock, 9:30, 10, HDFC Bank will be open and humming with activity. And whenever she's returning to pick her husband, 7:30, 8, 8:30, HDFC Bank will still be open and humming with activity. In the days when PSU banks were open from 11 to 3, she was able to see that HDFC Bank is working right from 9:30 to probably 7:30, 8:30 in the night. There were more number of customers in HDFC Bank branch than most of the PSU banks in Flora Fountain. Looking at this simple observation that this bank has more activity and is more customer friendly, she went and picked up 2,000 shares of HDFC Bank way back in the mid-90s. Over a period of time, she continued to hold that investments, and today it has delivered some 30% plus return to her. Simple power of observation allowed a person to accumulate or build a portfolio which has worked very well. Investment is all about common sense. Investment is all about trying to differentiate facts from the noise. And when you take this kind of call, undoubtedly some works, some don't, but the calls which work makes tremendous money for investors. Another example which I would like to share is my friend's father. In the 70s, 80s, 90s, he was working as head clerk in a chartered accountancy firm, again in Flora Fountain. His partners used to dabble in stock market. Those were the days of physical market. You will fill share application form, share transfer form. You will go to collect broker note confirmation. You will go to, again, settle Vandho or Valan or something like that. Now, all throughout, my friend's father was observing them and also maintaining their accounts. Observing them and maintaining their accounts, he could see a pattern where buying good quality businesses were delivering good return to their partners, and trading was resulting into disaster. Based on that observation, he himself started investing in market. You can very well imagine what an head clerk of a CA firm will be getting by way of salary, what will be his meager savings. And yet he was able to invest into markets, small amounts. In the mid-90s, when my friend's father retired, his wealth was more than many of his partners' wealth. It all happened because he was far more disciplined investors, whereas his partners were not that disciplined. Again, simple common sense, simple discipline ended up giving him far more return on his portfolio than his partners. The limited point here is that investment is commonsensical thing. It's very simple, but it requires tremendous discipline. One day someone asked Warren Buffett, what you say is so simple, then why aren't everyone as rich as Warren Buffett? Warren Buffett replied, well, making money is easy, but it requires patience. And not everyone has that kind of patience to make money. So limited point, please be disciplined about your approach. There are 3 rules which are necessary for financial freedom. One is regular investment. As our saying says, little drops of water make an ocean. Same way, small amounts invested regularly over a period of time creates financial freedom. The second thing is long-term investment. We don't expect mango tree to deliver good mangoes before 12 years. Same way, in investments, there's no option but to take longer term view. If you take short term view, kabhi aam khatte milenge, kabhi meethe milenge. But if you take long term view, chances of meethe aam is far more. The third thing is about asset allocation. Diversify yourself in debt, equity, real estate, gold, and offshore assets. Combination of that asset allocation ensures that you are able to withstand volatility and generate real return, more return than inflation. These 3 simple principles of regular investment, long-term investment, and disciplined asset allocation is good enough for any investor to generate financial freedom. As Warren Buffett kept on saying, the investment is all about common sense, which is not so commonly available. So investment really does not require intelligence. It requires more of emotional balancing, balancing greed and fear, maintaining discipline, and that is good enough to create financial freedom. With this, Nikhil bhai, I will end my talk, but happy to take questions which listeners might have.
Yeah, Nilesh bhai, people are going to have a lot of questions about markets, I'm sure, and I think we'll be taking, Diksha, over to you.
Thank you, Nilesh sir, for your wonderful session. And I request everybody to post their questions in the Q&A box, and Nilesh sir will address the same towards the end of the session. Now, let me again welcome Mr. Nikhil Naik, who is the Chief Growth Officer of AD Naik Group. He has been featured countless times on television and print media, and he has addressed over 12,000 individuals through various investor education initiatives. Ladies and gentlemen, let's welcome Mr. Nikhil Naik.
Thank you. It's an absolute honor, Diksha and Nilesh bhai, to speak after you or along with you. I've had wonderful learnings from you every time I've interacted with you. Today's session, today's session has made my job very, very simple. And I thought I'll cover some of the real life stories that we've gone through with our investors and we've learned in our last few years of journey. I'll just share my screen. Is my screen visible, Diksha?
Yes.
Yeah, thank you. So simple things can create great wealth actually. And the disclaimer is, we are very honest people. And so we ensure that the disclaimer is put up before the session, but we also make sure that the font is such that you don't get time to read and go through the entire disclaimer. However, one definite disclaimer that I would want to give is we will speak from our experience. We will only tell you what we've been doing at our own personal portfolio or our own investors. Some of the schemes that we may discuss may have investments of our investors. Some of the stock names that we will discuss are no tips for investing or buying or selling, and I'll come to that why it is so. But I want to thank each one of you from the entire Naik Wealth family. It's been a fabulous journey of learning with you guys, and learning with all the investors across 17 countries, and helping them to grow their overall portfolio, manage their money. Yeah. So I just want to ask everyone, which is the world's best drink? And there was a survey done on the world's best drink. Is it coconut water? Is it Coke? Is it any of these sodas? There is, of course, there is a drink which in Kuala Lumpur has been adjudged as the world's best drink. But actually speaking, the world's best drink is water, and it has countless benefits: no calories, no sugar, natural, freely available. And I believe Nilesh bhai talked about simplicity, and I cannot emphasize enough on simplicity. People, we all tend to mistake fancy stuff, uh, the new age stuff for returns. These are good things to own, but not necessarily good things to have and show it to our friends, but not necessarily good things to own in our portfolio. And I remember in August 21, we had a investor session, Nilesh bhai, and where we actually cautioned our investors about Bitcoin and the IPOs that were there. Not all IPOs are good. You need a lot more research, lot more insights to study these things. And we all know what happened to Bitcoin since then. Some of these coins are down 60% or so. One of the worst mutual funds of all from there is down about 18 odd percent. So that's the amount of in Ethereum I am told it is down by 75%. Not that I understand these asset classes, but we in fact in our August 21 investor webinar, we cautioned our investors. We compared it with the tulip mania that happened in Amsterdam in 1800. And also, we've always warned and cautioned our investors to trade into IPOs carefully. We believe that IPOs are a good mechanism for extremely savvy investors, because see, in IPOs, IPOs are the ones which come before before listing. So once a stock is listed, the buyer and seller have equal access to information. But in case of an IPO, the seller, who's the company or the promoter, has more access to the information than the buyer, which is a retail investor. So one has to trade into these options carefully. And I'll talk about what I do for all my investments. But we have to, Nilesh bhai also spoke about the asset allocation. If you look at overall asset allocation, one can divide our portfolio into mutual funds, stocks, bonds, fixed deposits, cash, and the new age companies or the unlisted companies, the cryptos can form a part of your portfolio. I do not have it in my own portfolio, but one can look at it. But these are alternatives. They cannot be vehicle to my core goals. They cannot be part of my retirement portfolio. They cannot be part of my passive income portfolio. They cannot be termed as my core investments. And that is the biggest difference that one has to really look at. The new age companies, the IPOs, the unlisted stocks, the startups, the cryptos, and they cannot, it cannot form more than 20% of my portfolio in total. And that also for extremely affluent investors. So that brings to me my first trick of in managing money is keep it very simple. Avoid fancy stuff. Fancy stuff is good to see in movies like Ranveer Kapoor or Ranveer Singh, but not exactly good to own in your portfolio. The second trick, and Nilesh bhai spoke about it, was avoid the guru syndrome, the neighbor syndrome. Don't buy anything just because of the neighbor has come and bought. And we've seen that investors all of us love to talk about our successes, but we rarely talk about our failures or one of our worst decisions in investments. And the third is obviously avoid the brother-in-law syndrome also, where, just because my brother-in-law is buying something, I should not buy. I think when we talk about gurus also, even when we talk about Buffett buying something or selling something, my decision cannot be based on what he's doing, because his portfolio is different. And we've always said this to our investors, that personal finance is more personal than finance. So it has to look at what is your age, when are you going to need money, when are your kids going to go to higher education, when are we going to need that money. A lot of those decisions will decide what you should be buying and what you should not be buying. Also, don't marry investment ideas forever. If you've bought something, there's no point in rationalizing if that decision is bad. And some of the wealthy investors that I have seen are very quick to accept mistakes and move on to their newer things. But then people come and tell me that the smart money is going out, FIs are pulling out, and Nilesh Bhai will answer some of those questions now, and I will tell us how to do it. But I'll just tell you one thing, that these were very exceptional times. They were, there are decades that nothing happens, but this was one few weeks that we've seen three times where decades have happened. One at the time of lockdown, the other one was the war, and then now what we are seeing is the inflation. So but I remember one of our investor, and Nilesh Bhai, just like the doctor story that you narrated, we had one investor who came in and couldn't handle the lockdown pressure. And he was at 1.1 crore invested. The blue line is investment amount. The green line is the value. And at 1.1 crore of investment, 1.6 crores of value, he simply exited everything and went home. One of the things that I've seen with markets is, I think that I will come back again. It's extremely difficult. Markets don't let you come back so quickly, because once the markets go down, you keep hoping that the markets will go down further. And when the markets start going up, you think that at some point of time I'll get a buying opportunity, and you never get to enter. And if you see his portfolio, he's today at 61 lakhs with 88 lakhs. The average 10-year return has been 4.5%, because one single mistake actually pulled him back to these returns. There was another story where a friend of mine couldn't handle the pressure in 2013, when the markets were not doing well for October 2013 and also, and came and exited everything around 2013 or so. And then I had told him that you waited for such long period. He was an investor since 2004. Why don't you wait for some more time? But he didn't wait. He couldn't handle it. He exited. And then we all know Modi government came in and the market started rallying again. Luckily, he could not get in to ride that rally, but luckily he could still manage to get in over a period of time. This time when the COVID struck, he knew the mistake that he had done in the last fall, and he didn't exit. And as we see, his 74 lakhs is about 1.7 crores. The lifetime return is about 12%, close to 12% since 2004. So this that Nilesh Bhai spoke about, the emotions, managing the emotions can actually play a big role in your portfolio. And I'll end with one of this last example of my favorite example of investor. That April 2001, this investor had he had started investing in 2000 or so. April 2001, his 41 lakhs of portfolio had gone down. Just a minute. Yeah, gone down to 9.7 lakhs. Nilesh Bhai, if you remember, those were the tech burst days where markets had fallen significantly. The loss was 31 lakhs. He managed to continue for next 6 years or so by kept investing in the markets. By November 2007, at the peak again, the portfolio became 3.7, became 7 crores, the housing boom, and the markets crashed. Feb 2009, just before the recovery, the 3.7 was 3.2 crores. So imagine the 7 crore had become 3.2 crores, but the investor managed to ride that volatility because he didn't need money during that time. And then you see the next cycle, what happened. He rode through the next cycle. April 15, 4.7 had become 13 crores. And then he needed money after that. So he kept withdrawing the money. The capital, he had recovered his capital by March 20. His investment had recovered, and he had 1 crore plus actually. So minus 1 crore was investment. The value was 8 crores. he rode through this whole of this year, and then obviously exited just before in January because he needed money. The whole point I'm trying to make is he's actually gone through all these cycles, and by going through these cycles is the only way you could actually make a lot of money. And so we feel that, the trick three is spend at least 1,000 days on your portfolio, because they say that 1,000, what we eat in first 1,000 days, ever since we are, born in our mother's womb, decides our health for next 100, whatever, 80, 90 years that we live. So what we do to our portfolio in first 1,000 days is very, very critical. See through the cycles, and that's one thing that we can actually make money. And one of the things that this is a TED talk that you all can watch, that create a scout mindset. Try, when you are fighting on the ground, we can barely see 100 meters, 200 meters. A soldier cannot see, fighter cannot see beyond 100, 200 meters. But a scout in a war climbs up on the tree, goes up higher, zooms out and looks at the overall picture. And zooming out in between on your portfolio is extremely important. Taking a very close view can actually be misleading at times. You have to look at your investments in a micro manner also, but a macro view in between is also extremely important. In fact, we developed a tool called RRR, where an investor can review, revive, and restructure his investments. It takes about 30 minutes of time with one of our colleagues, one of our wealth coach. I would strongly encourage you to look. This gives you a holistic view of what is happening to your investments, which are the underperformers. Are you making more money than inflation? Are you making less money than inflation? And I would strongly recommend you to go through this exercise. And they say that 1% improvement in your portfolio returns on 1 crore over a period of 20 years can give you a gain of 22 lakh rupees. So you can actually improve, you can gain by doing 1% improvement, higher returns in your portfolio can actually give you 22 lakh rupees over a period of 20 years on a portfolio of 1 crore. So with that, I would thank each one of you for being part of this webinar. And Nilesh Bhai is here. We all must learn and have all the questions about markets. Nilesh Bhai, we are definitely, although we are saying no guru syndrome, but we've seen you, how you've been like a common man's friend over a period, common investor's friend for last so many years. So with that, thank you very much. I would hand it over to Diksha to take over the question and answers, and also about the current market situation.
Thank you, Nikhil sir, for your wonderful session. Now that we have understood the importance of a 1% change, let me check with you all if you wish to make a 1% change in your investment journey. I would request you all to take a poll. I'll wait for 5 more seconds before I close the poll. Thank you all for taking the poll. And to those who have shown interest, we shall get in touch with them to schedule the appointment. Now, I would like to go forward for the question and answer session. May I request my colleague Ninad to ask the questions shared by our participants to the speakers.
Thank you, Diksha. Nilesh Bhai, let me start the questions with you. What we had done is that at the time of registrations, we had requested the audience, if they had any questions, they could put it in the registration at the time of registration itself for you as well as to Nikhil sir. So I've made a list of the questions out over there. So let me start the questions with you. The very first questions is something related to the markets. And it comes from Mr. Siddharth Jaiswal. He wants to know, why are the FIIs becoming net sellers? Over to you, sir.
So FPIs are selling, one, because they have made profit in India. In markets like Russia, they have lost $260 billion. In markets like Turkey, Mexico, Indonesia, South Africa, China, they have lost money. In India, they have made money, so they can sell. Second, they are selling because India is expensive vis-a-vis other countries. We are today trading at double the valuation of China, double the valuation of Brazil, double the valuation of South Africa. So we are expensive vis-a-vis others, and hence people are selling us. Third, there is constant negative publicity about India, especially related to Russia tilt and social harmony. Now, when you open the newspaper and only see negative news about a country, obviously it's bound to impact you. Some people might be selling because of that negative publicity. Some people are selling because oil prices went up to triple digit, $120, $125. India is one of the largest importer of oil in the world. Our oil intensity is much higher than our peer group. So when one believes that oil prices are higher or likely to remain higher, they are bound to sell India compared to other countries. So there may be many drivers driving FPIs to sell right now: valuation, profit booking, impact of higher oil prices, negative publicity. But all those factors put together has allowed FPIs to sell about 6% of their holding. They have sold $36 billion worth of equities between October 21 and today on a rounded of $600 billion market value portfolio. Their holding has collapsed from about 21.5% of NSE 200 to about 19%. And in the recent time, lowest one was 18.6%. So hopefully they are reaching a level where they will be one of the lowest holder of equity in India. And slowly and steadily, as oil prices come down, some of the selling pressure will get reduced.
Thank you. Thank you so much, sir. The next question I would like to ask to Nikhil, sir. This question comes from Mr. Nitin Pandit. He wants to know, what is your advice to senior citizen investors?
So one of the things that Dr. Pandit Saab, I feel is, if a person is retired, there is no fresh capital that is getting generated. So a part of your investments should give you regular returns, but a part of your investments should definitely create more money, because you're not going to bring in more money. And one of my favorite advisors, Nick Murray, says that before 60, you should have close to 100% in equity. And after 60, you should have close to 100% of investments in equity, as much as you can emotionally and financially manage. So these two things are extremely important, financially and emotionally. You have to ensure that you don't, any money that you need for next 3-4 years cannot be in equity. Rest of the money, 5 years, let's say 6 years of money that you don't need should not be in equity. Beyond that, all the money can remain in equity. Yeah.
Thank you, sir. Nilesh, sir, this question comes for you. And this comes from Mr. Vijay Nalawala. He inquires, the broader markets, mid and small caps, are correcting at a faster rate than the blue chips. Was this expected to happen?
So undoubtedly, the mid caps and small caps were trading at a richer valuation compared to large cap. Let's say in October 21, they were trading at similar richer valuations in July 21 also. And from that point of view, it looked like that there will be some correction. But between July to October, no correction occurred. Mid caps continued to outperform large cap. But finally, the corrections came. The driver might be higher oil prices, Russia, Ukraine, FPI selling. But invariably, the correction came. And today we have seen small caps correcting more than mid caps and large caps. And mid caps finally correcting little more than the large caps. So we didn't know exactly when the corrections will come, but we did knew that large caps are looking better vis-a-vis small and mid cap from a valuation point of view from the middle of 2021.
Thank you, sir. This next question is for Nikhil, sir. Nikhil, sir, this question is from Mr. Nikhil Girme. He wants to know, is PMS better than mutual fund? If yes, how? So you're on mute.
Yeah. No. I think again, personal finance is more personal than finance. All products are good. All products are bad. If they suit my requirements, yes. If they don't suit my requirements, the answer is no. If the way I have personally devised my portfolio, and I'll just share that I do not have a active demat account, meaning I don't trade, or I don't have a trading account. I never trade in stocks. I never buy stocks on my own. Whatever my money is invested either in mutual funds that we talk about, and one of the large investment happens to be Kotak blue chip and Kotak small cap and one of the largest longest running SIP. I run a 17-year SIP now with Kotak blue chip, and it has done very well for me. However, some small part of my investment goes into PMS, but it cannot come. First, I have to complete my core investments. PMS, AIS can be part of my outside, slightly outside the core portfolio.
Nilesh, sir, this question is for you. This is asked by Mr. Sandeep Gokhale and Mr. Shama Bade. Given the current COVID situation, war, inflation, Fed rate hikes, etc., what is your outlook for the next 5 to 7 years? And what should be the course of action for a retail investor?
So to retail investors, I will say keep the faith on India growth story. Undoubtedly, recent times are challenging. Higher oil prices, higher inflation, global uncertainty thanks to Russia, Ukraine. But India growth story will overcome all these obstacles. If we look at 2014 to 2021-22, we faced COVID-19 lockdown. We faced higher oil prices in 2014 as well as 2022. We witnessed, US interest rates going up and down. Russia, Ukraine came. So I don't think so. There are many worse things which will happen between 2022 to 2030, which we haven't seen in 2014 to 2022. Now, in last 8 years, we have grown. India was 10th largest economy in the world in 2014. Today, we are 5th largest, bigger than our former colonial master, United Kingdom. Our share in global GDP was 2.6%. It went up 23% to reach 3.2% in 2021. Our share in trade and exports was 2%. It went up 10% to become 2.2%. The growth in exports was lower than growth in GDP. That was primarily driven by the fact that India is a local economy than export economy. But more importantly, our share in FDI moved from 2.1% to 6.7%. Today, in the world, whenever someone is investing outside of his home country, 6.7% of that comes to India. That means people are more bullish about India for future than in the past. We were 7th largest automobile market by volume. Today we are 4th largest, and very soon we will overtake Japan to become 3rd largest. We were 4th largest steel manufacturer. Today we are already 2nd largest behind China. We were 12th largest mobile manufacturer. Today we are 2nd largest. We had 4 unicorns in 2014. Today we have 103 unicorns. There was a club called BRICS Club, Brazil, Russia, India, China, and South Africa. If I remember data correctly, our weight in BRICS was 16% in terms of market cap. Today it is 22%. That means everyone else's share has gone down and our share has gone up. So between 2014 to 2022, despite all these challenges, if we have grown our export share, GDP ranking, automobile, steel, mobile phones, unicorns, then undoubtedly we will continue to do the same thing going forward also. So to retail investors, my recommendation is keep faith on India growth story and continued investment in the market. Don't get worried about current volatility. Undoubtedly, many of you will be suffering losses, but this is to ignore the pain of losses and staying invested in the market.
Sir.
I remember Nilesh bhai meeting you in your Crore ICICI days. I don't know when was that. Long back. I think it was what
2004-5.
Oh yeah. And I had asked him the same question about Indian stock market. तो आपने कहा था यार निखिल हम लोग इतना मेहनत करते हैं, ट्रेन में जाते हैं, भीड़ में धक्का खाते हैं, ट्रैफिक में रहते हैं, you know, we are far more resilient to many things and we are bound to grow. And I think it has come true. I mean, 18 years, I think we've grown, and you narrated the story of how we've grown over a period of time. So yeah.
Amazing, sir. The next question is to Nikhil sir. This comes from Mr. Raj Daga. Raj Daga says, what allocation will you suggest between equity, debt and gold?
Raj, I know your age. I think you should have everything into, I know his age, I know your background also, you should have everything into equities. However, in current markets, I think Nilesh bhai can also throw more light on this, that how much one should have into gold or equity. But if you're 20 some or less than 30, I think 100% equity over a 20-year period. But yeah, from a large portfolio, we would definitely keep some cash on the table to be invested if there is any fall. Nilesh bhai, what would be your suggestion in the current situation?
So Nikhil bhai, each one according to their investment objective and risk profile. It's very important to get a tailor-made solution for perfect fitting. लोग शादी में भी सूट सिलाना पसंद करते हैं because perfect fit चाहिए. So here तो we are talking about financial health. You need to figure out what is your risk profile. अपने में कहावत है कि कौवा चला जो हंस की चाल तो अपनी चाल भी भूला. In stock market उल्टा है, हंस चला जो कौवे की चाल तो अपनी चाल भी भूला. So please understand your risk profile. Don't make a mistake like what my friend's family doctor did. He was very conservative investor. Unfortunately, he ended up taking a risky call. If he had understood himself well and taken a less risky product, more conservative product, I'm sure his return would have been much better. So you have to divide between debt, equity, gold, real estate, and offshore assets. But the division is dependent upon what is your risk profile, how long you want to invest into, and it will be very, very individual decision, which, Nikhil and team will be in a far better position to talk to.
Thank you, sir. The next question again is for Nilesh Bhai. Nilesh sir, this question comes from Kunal Bahal, Suhag Desai, and Mr. Amit Yajurvedi. Is a global recession a high probability in the near future? If yes, how long will it last, and what will be the best way to grow our portfolio during this time?
So we believe global recession is a very, very reasonable probability. US first quarter number came at minus 1.4%. There is one US Fed in Texas, which gives high frequency indicator to forecast what will be the GDP growth in the quarter. They were at 1.5% in beginning of June. They became zero towards middle of the June. And looking at the numbers now, probably they would have become minus 0.5% by end of June. So US will be growing negatively for 2 quarters in a row. It will be considered recession. Now, globally, China, India will continue to grow faster, and hence the world will not go into recession. But US, Europe will certainly certainly staring at recession. Now, when recession happens, how should investor protect his or her portfolio? Well, again, you have to buy what is cheap and sell what is expensive. It's quite likely that we are going to see globe in 2 parts movie. The first part of the movie will be where interest rates will be raised, liquidity will be tightened, demand will be reduced, and hence growth will be negative. This second half post interval will see the reversal where interest rates are down, liquidity is infused, demand is inflated so that growth becomes positive. We don't know the duration of first half. We don't know when the second half will begin. But undoubtedly, if the movie has to end happily, then second half has to follow first half, which is where it is extremely important for you to do your asset allocation. Let's assume someone invested only at 18,500 Nifty. At 15,500 Nifty, his portfolio will be down about 15-18%. But this is the time to buy more equity without worrying about already 15 or 18% which you have lost. Maybe after your buying, markets will fall further, but you'll have to keep on buying what is cheap and sell what is expensive. That discipline will ensure that your portfolio is positioned for the second half of the movie, where returns will come dramatically. So simple answer, the world will go up and down. You maintain your asset allocation, buy what is cheap, sell what is expensive. Eventually, this strategy pays off.
Thank you, Nilesh sir. The next question I would like to ask Nikhil sir. Nikhil sir, the question is, why do mutual funds never say to sell and sit on cash? Now, this question is coming from Mr. Ram Nivas Agrawal.
I think there are a lot many mutual funds which also talk about systematic withdrawal plan, and a lot of funds talk about taking money off the table. There are a lot of balance advantage funds which have been launched by mutual funds, which ensure that the markets, the equity asset allocation goes up and down depending on the market levels. But by and large, if you see, Levi spoke about how owning HDFC Bank, or how, see, we've been a savers country. I think we have to move to an investors country, and our overall asset allocation at the country level is very, very poor when it comes to owning equity as an asset class. And Nilesh bhai, you had spoken about how we sold off equity and bought gold in last 20 years or so. And I think that is one of the reasons why equity has become one of the most popular things. But and Rishbhai can talk about data. A large part of mutual funds assets come from fixed income or liquid funds and other asset classes. So yeah, Nilesh, I think maybe you could add to this.
So it is
Yeah.
unfair to say that mutual funds don't say sell. We run a fund called Balance Advantage Fund. Their equity allocation is between 20 to 80%. In Jan 20, we had about 39% allocation to equity. With the benefit of hindsight, it should have been 20%, but 39% was certainly on the lower side. That was a clear signal to the world that we are underweight equity, not by a big number, but by a small number. In March 20, we were at 75% equity allocation. With the benefit of hindsight, we should have made it 80%, but fair 75 was not bad. Again, a clear indication that one should be overweight equity. Today, we are roughly at about 50% allocation, which is kind of neutral equity. If market corrects, I'm sure 50 will increase to 55 and 60 and 65 and 70. So there is a fund where we publish on a daily basis what is our equity allocation, so that an investor, if he wants to make a judgment, can take a call whether he should be underweight equity, overweight equity, or neutral equity. Now, if you're neutral equity in today's market, please continue your SIP. If you're overweight equity, please take some profit out, because this is not the market to be overweight. But if you're underweight equity, you still have to go and invest in the market through STP route. So to each person, there is different solution depending upon their investment horizon and risk profile. And which is why you don't see fund manager talking about buy or sell, but fund manager talking about maintaining asset allocation. And I'll recommend either you listen to Nikhil Bhai to figure out what should be your allocation. And if you want a thumb rule, look at our Balance Advantage Fund equity allocation on our website on a daily basis. Whenever allocation is between 20 to 40%, that is underweight equity call. 40 to 60% is neutral weight equity call. And 60 to 80% is overweight equity call.
So the next question to you comes from Mr. Hemal Chandan. And he's curious to know if you can give a broad overview of the steps that a fund manager takes in his portfolio when the markets go down.
So whether markets go up or down, my approach doesn't change. My job is very simple. I want to buy good companies run by good managers available at good prices. बोलना एकदम simple है, करने में जान निकल जाती है. What do you mean by good business? Any business which on a business cycle delivers more return than cost of capital is a good business. If you are earning 12% and you have to pay 8%, you will generally succeed. If you are earning 8% and paying 12%, you are bound to be a failure. So we want to invest in businesses where return on capital is more than cost of capital. Second, it should be run by good manager. Now, कोई thermometer तो है नहीं कि मुंह में डाल के measure कर ले बंदा अच्छा है बुरा है. So you build your confidence whether this manager is good, bad, or ugly, looking at his past behavior, looking at his past performance, looking at his future vision, looking at how his views are on minority shareholders. So you take a judgmental call on the promoter whether he is good, bad, or ugly. And finally, third thing is good prices. When we say good prices, it doesn't necessarily always mean cheap prices, because market is not kind. They are not going to give you opportunity like March 20 every year. Markets are markets. They'll be bullish, they'll be bearish, they'll be neutral. So you still try to figure out a price at which you think valuations are reasonable. And then put that into portfolio from a liquidity point of view, from a benchmark point of view. You may like a small company a lot, but you don't make it your top holding because there is liquidity issue, there is governance issue. So you build portfolio of companies which you believe are good businesses run by good managers, available at good prices, which will be liquid in nature and which is poised for better performance over a period of time. This we do it in a rising market, this we do it in a falling market. This we do it in a market which is not moving. My job doesn't change because markets have fallen, it remains the same.
Thank you so much, Nilesh sir.
In fact, Nilesh sir, on that note, in fact, when we look at fund managers and when we try and identify good fund houses or good fund managers for our investors, one of the things that we see is how consistent has the fund manager been in his approach, in his and calls can go wrong, calls can go right, but then the approach cannot be inconsistent. And also, I think you beautifully touched upon how the portfolio is constructed. The construct of portfolio is also very important because it's a public money. You cannot have illiquid, too many liquid stocks and all. And I think, and that is the reason, one of the reasons why you guys are part of the award-winning team. So, yeah.
थोड़ा लक, थोड़ी मेहनत, चल जाता है गाड़ी.
I would like to ask the next question to Nikhil sir. This question comes from Mr. Gajanan Doizer. What single thing should we avoid this time?
I think when I met Nilesh bhai last time for this event, and he said that अगले 6 महीना पकड़ के रखना चाहिए as an investor. I think, yeah, there is a fine line between greed and fear, and Marathi में उसको लाभ and लोभ बोलते हैं. लाभ is benefit and लोभ is greed actually. तो वो उसमें बहुत small फर्क है. We have to stick to what is right, like he said, follow the dharma, what is right for us, and not get panicked. Zoom out in the 3R model that we've developed. We've actually looked at trying to zoom out at all your investments, fixed deposits, PPF, PF, all of those things. You can do it. You can do the analysis yourself. So I think zoom out is one thing that we should always do. And I remember Nilesh bhai Mr. Uday Kotak had tweeted, or I think he had said in one of these things that if something is too good to be true, it cannot last for long.
Yeah.
And if things are bad, it cannot last for too long. So I think that is one thing that I would want to probably highlight here. Yeah.
जैसे नेचर में पूनम के बाद अमास आती है और अमास के बाद पूनम आता है, वैसे ही मार्केट में तेजी के बाद मंदी आती है और मंदी के बाद तेजी आती है.
Beautifully put. Beautifully put. Sir, with your permission, I would like to take one last question for you, Nilesh sir. This question comes from Mr. Sumit Durga, and he's inquiring about crypto. Right, this is something which is quite prominent nowadays. We hear a lot about crypto these days, and he's talking about crypto being a hedge, right? The way gold has been a hedge at times. He talks about crypto being a hedge. If you can just share your thoughts on it.
So, frankly speaking, there is no last word out on crypto. There were many die-hard believers of crypto. And there were many, like Warren Buffett, he said, I wouldn't buy entire world's crypto for $25 because the value is zero. Now, he made this statement when cryptos were still rising and not crashing like what we have seen. My feeling is that हम में से बहुत लोग सावन के महीने में जुआ खेलते हैं. हम में से बहुत लोग दिवाली की रात को भी जुआ खेलते हैं. Now, उस जुए में आप जितना पैसा लेके बैठते हो, उतना पैसा आप क्रिप्टो में लगा सकते हो. जुए में पैसा चला जाए तो आपका सावन का मूड खत्म नहीं होता, दिवाली का दिन खराब नहीं होता. सेम वे क्रिप्टो में उतना ही पैसा लगाइए, which if you lose, it's not going to spoil your mood. It's difficult to say what is the fair value of crypto because there's nothing underlying. For old conservative value biased investors, crypto's value is zero, and they wouldn't buy it even at $5, forget $5,000. there are many new age people who believe crypto is decentralization. Crypto is answer to the monetary inflammation caused by reckless central bankers. We don't know where the truth will be, who will win. So my recommendation, treat this as a gamble. उतना ही पैसा लगाओ जो चला जाए तो आपको फर्क नहीं पड़ेगा.
Thank you so much, Nilesh sir. Thank you so much, Nikhil sir. I hand it over to Diksha to take it forward.
Thank you, Nilesh bhai. And I think these are going to be tough times, but these are the times for accumulation for people to come. And I feel like bull markets will make us rich, but bear markets can create fortune, hopefully create fortune for all of us in times to come.
Absolutely.
Thank you, Nilesh sir. Thank you, Nikhil sir. Now, before we wind up the session, let me rerun the poll for all those who had missed it taking earlier. For those who already taken it, it's okay if you don't take it again. So I will keep the poll on for another 5 seconds. Thank you to our speakers for taking out time and addressing the investors and answering their queries. A humble thank you to all the investors who took out time and attended the session. We sincerely believe that we were able to add value. In case you have any queries, we are just a call away. Feel free to call us. I would also like to thank the entire team of AD Naik Group for the support and making this session a success. Thank you all.
Thank you, Nilesh bhai and entire team of Kotak. Look forward to meeting all our investors and you guys in person very soon. Thank you.
Definitely. Chalo. Bye.
Bye.